All right, everybody, thank you so much for joining us on this Tuesday's editions of the Precision Markets Office Hours. For those who this is their first time joining in, we host these weekly office hours to be able to discuss any kind of concepts, questions, and be able to show charts or anything that you need to visually for a question that you have within the chat. The format is you're going to submit your questions within the chat, and then we'll answer them in the order that they're received. We may also ask you for audio, but please be respectful of the order that everybody comes in the chat. So either Nathan or myself will answer questions. And so with that, we'll go ahead and begin, and I'll let y'all go ahead and ask away any questions that you have. Don't be shy, everybody. How banks open orders? Well, Peachy, I will share this one because this one was very interesting to me. So, um, and when it comes to bank orders, right? We do think about the fact, like, here's some interesting statistics that I got. When it comes to the Forex market, foreign exchange is over 70% of people that hold their money in Forex sell it at a lower price, meaning they take a loss. So the market is basically filled with people who are mostly retail traders, because for the foreign exchange market, it's not really driven by institutions. Now, on the flip side, banks have a strong forex market, since like Chase Bank alone, like JP Morgan Chase United States, supposedly does like 7 trillion on Euro USD alone, with either in a day or in a month. I can't, Pierce Crosby from TradingView couldn't remember which one it was, but they spend $7 trillion on Euro USD alone. So you got to understand, for banks have more than one market offering that they have. They also do a lot of loans and such like that. No, the foreign exchange market does $7 trillion in a day. So JP Morgan Chase operates over $7 trillion in a month worth of Euro USD. So when it comes to banks are influenced by they're influenced by their different product lines, but the stronger influence comes from what happens from a central bank perspective. So if interest rates rise, that's when they adjust their order books. And so the whole idea is that when banks operate the orders, they can stay on drawdown for months into years sometimes. But what happens is they have order volumes and order books that are done during one session, and then that order book has to transfer to the next session. So banks have the orders, they don't hold it really overnight, but what they'll do is they have order books. This is the part that I'm still trying to understand. They have the order books that will transfer, like the end of New York. When you go into Asian session, on the other side of the world, other banks pick up those orders and then are able to continue the order flow and volume. What ends up happening is that the reason why there's effectiveness with strategies is because you get aligned as your strategy goes on to a certain pattern or procedures of a certain bank that helps to generate the market direction or the market volume for the trades that you take. When they have, for instance, the central bank decides, oh, they're going to raise interest rates, that changes how the bank decides to do their order books and their volumes. And then that's when you start seeing trades, for instance, that don't come back to your 1 minute entry zone, or you start seeing that the market doesn't ever pull back. And now the effectiveness of your strategy changes. So it's interesting that the way that banks kind of do things are based upon order volumes, which really follow supply and demand, which is why we have a really strong concept that can help us to be profitable. But we have to watch how we align to certain patterns that constantly can change based upon whatever factors come from the central bank. That's why I said the DXY is really it's not important, because what you need to know is on the chart. But what you really need to understand is that banks don't really validate technical levels. Banks have, pricing levels where they want price to go, or they believe price has a ceiling or floor, but that all gets influenced also by influences from the central bank. So it's not important for us to exactly predict what the news is going to do. It's to be aware of the impact that news could possibly have on how banks think. And that really opened my eyes, because a lot of times we go in trades, we don't think about news, but news has an impact, because 96% of the market is made up of banks and Forex. 3%, 34% is retail traders. So if they move and do something different, it affects everybody. We're not in a market that we play in. We're in the bank's market. So if we don't understand how the banks operate, we really don't know what we're doing. So that was one of my biggest epiphanies, like how banks open orders. All right. Love Sandu. Can you show a top to bottom analysis? I mean, analysis from the very beginning, 4 hour to 15 minute to 1 minute. Nathan, do you want to share your screen and do it just like a top down really quickly?
So I'm on the ground's computer at the moment.
Okay.
Maybe I can open our trading view 1 second.
No worries. I have to open it myself. I thought I had it open and then I realized, oh, I didn't have it open. Give us 1 minute, guys, as we get prepared. But yeah, I hope that makes sense, PG, regarding like how banks open orders, because that kind of changed everything in my mind, like how we really approach news in the market, really. I think we've been so caught up in trying to catch the news. It's like, no, we just need to know what goes on, because that will change the way that we approach things. So, yeah. See. Let me know whenever you got it, Nathan. If not, I think I got my trading view pulled up now, so I can pull it up too if you needed to.
If you want to go through your one, I'm just trying to log in here.
Okay, no worries. All right, guys, give me a shot real quick. Let me know in the chat if you can see my screen, or let me know if y'all can see my screen. Yep. Okay, cool. So, I mean, this is how I kind of approach it. The very first thing when I'm thinking of top-down analysis is I go to the 4 hour, right? And there's about 3 questions I really want to know on the 4 hour. And let me see if I can pull them up. Yeah, here we go. First, what is the trend? What wave are we currently in? And what area in the trading time frame could possibly reverse? So looking at, for instance, GBP, JPY, price is in a downtrend, right? So price ended up making lower low, lower high, lower low, lower high, higher high, and then cannot make a lower low. Even though it broke structure, it still made a lower low. So I got potentially 2 things I want to watch. One, price could come into this 4 hour supply zone, and it could do 1 of 2 things. It could go up, come in. Hold on a second. Oh, yes, right. It can go up, come in, and then come down. So it could do something like this, and then come back up and do that. Or it could just go and break through, come down, do something like this. Whatever it decides to do, I'm not going to predict it. Right now, my current intuition is let's just see what price does going into it. So from the higher time frame, I know the trend is in a downtrend currently. I know that currently we're in a pullback phase. So that's what I considered the wave part, which was number 2. And then this is the area where it could possibly reverse if it goes into it. So now at this point, I've asked all the questions I need in the higher time frame. Now it's time for me to go to the 15 minute. So now I have a new set of questions that I pull on the 15 minutes. First of all, I want to know what is the trend. Second, what is the area that we could watch for a trade entry? My bias is that we're buying. Right now, currently, what do I see? Price ended up coming from pretty much somewhere down here to this high, this low, this high. It bounced off of this demand zone. So my expectation is that it's going to pass through because the high is weak and it's going to come and do something like this. The reason why I expect this is because, remember, this darker orange line right here. In fact, let me change this to a different color. I'm going to make it purple. This purple line was from our 4 hour. The bias is that we're buying. The orange lines are showing you exactly what's currently happening from an order flow perspective. So price kind of tapped into this demand zone right here from a 15-minute perspective. And so what I would have been looking for is looking for entry possibly at this point here once it comes and taps to the zone. So the 2 questions I'm asking for is that currently demand is in control from a trading time frame perspective, which is 15 minutes. And then ultimately, I found this area of a POI where price could possibly reverse, which ends up being extreme. When price actually taps into it, that's when we look for going into our actually entry time frame for us to be able to take the trade. So that point, that's when you go down to your 1 minute time frame. And then from your 1 minute time frame, these are the questions that I ask myself from a 1 minute. So first things first, do we get a reaction from our trading time frame area? Well, price went through it. Okay. Do we see orders flowing in our direction from the trading time frame? The 4-hour bias is that we're buying. My 15-minute order flow is showing that demand's in control. So what I'm looking for is for price to continue going there. So what I would look for in this case is look for price to come. Here was the last low. It was broken right here, which means that this little area right here was a 1 minute supply. And so once this 1 minute supply was broken, I would have been looking for what kind of demands do I have? So here was a demand zone right here that was on the 1 minute. This would have been a demand that not your extreme demand, more like a decisional demand. Here would have been my extreme demand. So the third question I asked is, do we see entry point in the time frame? Well, when price was coming from right here, and it comes all the way past this supply and it comes back, I'd have been looking for it to come to either this demand or this demand. Now, how do we know which one's correct? We don't. We just have high probabilities that price could do anything at one of these 2 points. So what you would do is you could decide to do half risk and put limit orders on both of them. You could decide that you decide to take one. You could decide, that, hey, I'm gonna take price at the decisional, or hey, I'm gonna take price at the extreme. Or you could have rules that say, I take price on the first demand that causes the flip zone. So for whatever reason, you would decide your reasonings. And then you go down to deciding where do you put your stop loss and take profit. Many people in the community will cover, for instance, here is the demand zone. We'll cover a little bit for spread and enter. Some people may decide, hey, I'm going to cover both zones at the same time. It'll lower my risk reward, but it's still enter for a trade. Whatever it is that your decision that you decide in your trading plan, you would just stick to that. And then from boom, you would take your trade. And do something like this. Let me know if that makes sense on how to do the top down. Cool. Awesome. All right. Next up, can you explain the concept of inducement and liquidity? Nathan, you want to share that piece?
Yeah, sure. So inducement and liquidity are somewhat of the same thing. However, I think everyone views inducement in their own sort of way too. So for me, inducement is when the market basically manufactures liquidity in order to lure retail traders into positions which are used then to be swept. So for example, if you have a demand zone, right? Let's say you want to take a trade from that demand zone. So if you're someone that wants inducement, you have it included in your plan. You would want to see some sort of equal highs right above a demand zone, right? This induces retail traders to believe that there's somewhat of a support at that price line where they set orders, stop orders too, and price comes down to sweep it into demand. So that's all inducement is. It's essentially liquidity, but I would see it through my point of view as a way of luring in retail traders. Now, we can have it in the form of equal lows, equal highs, or trend line liquidity, even patterns that are manufactured as well. And yeah, that's pretty much it. So 4-hour is used to identify market structure. Yeah, so 4-hour is our main directional bias, and we just trade from the 15s, as you've seen Brian do right there.
Kate asked, what up, bro? I'm sorry, I missed your message earlier. And you said annotate? Oh, do you want us to show us on the screen? Oh, I think they were wanting you to show it on, I guess, a chart, I think.
Yeah, sure. So I'll just bring up the chart now. 1 second. Oh, yeah, you can do whiteboard too, right? You
Yeah,
guys see this whiteboard? Yeah.
yep, we can see it.
Yeah, sweet. So you have a few forms of inducement. So I'll just explain a couple of them. So let's say we have a demand zone, right? That break structure, right? So we have a demand zone down here. So when it comes to inducement, what we might see is something like this, where we get equal lows right above the demand zone. They get swept and then taken. So this could be used as a form of inducement to lure in our retail traders. Other types of inducement are inducement in the structural leg. So let's say we have another break of structure here. And what you might find right after the break of structure, at this area here, you'll see that price will somehow just dip down ever so slightly on its continuation upwards, just leaving a little bit of liquidity here. And as price comes down, it'll form equals with these lows right here, and then sweep them into the demand zone. So that's a form of inducement. You've got trendline liquidity too on the way down to your zone, so price can come to sweep it. There's many forms of inducement. It's quite broad, and people see it in many different ways too. So, it's really up to you, to be honest. But that's my main form of inducement.
Does that make sense, guys?
It's quite subjective, I guess you could say at times, because it's essentially the same thing, but how you view it, it's really down to you, You don't use inducement or liquidity, brand new. Awesome. Mm-hmm. All right, so what's next? You here, Brian?
Yep. Sorry, guys. I was reading through the chat. Trying to remember where we were at. All right. And then Eddie also had a question. So 4 hour is used to identify market structure.
Directional bias.
Yeah. So the thing is, we always talk about in like the course is called higher time frame. Well, not higher time frame bias, but higher time frame direction. And it's also, for instance, like considered what you call a bias. Now, sometimes you'll hear that biases are bad, but biases help you to get a sense of elimination. You have to, in the trading, we have to make logical conclusions based on the information that we're given. And so you have to come to some sort of consensus if it's either going to go up or down. Because to be honest, you have a 50% chance of getting a trade right or wrong. 50% of the time, trade's either going to go up or it's going to go down. If it goes up and you said it was going to go up as you like bought, then you make money. If it goes down and you bought and you thought it was going to go up, you lose money. So to get us a better odds of 50%, we have to use these other factors that help us to influence that. Oh, now it's a 70% chance that it's probably going to go up or down. You got to use a higher time frame when you do your entries to be able to eliminate a lot of the losses that you would take because you just made the wrong decision about direction. And so if you base your bias using higher time frame market structure, it really helps you weed out probably a whole bunch of losses that you would take. So that's the reason why we look at the market structure on the 4 hour to say, hey, well, if we know expectational order flow and the market's in an uptrend and I see price just made a higher high, well, guess what? Expectational order flow would have us believe it's a theory that price would come down to a demand zone, make a higher low, and then go past the last higher high because the high is weak. So we use all of these factors to help us to be able to make a educated decision as to if we should be buying or if we should be selling, if that makes sense. So let me know, Eddie, if that is clear. Okay, cool. All right. Hey, EJ. Good to see you in the chat, brother. Go ahead and share your chat and share your chart, and we can talk through the last trade that you showed.
For the chart, it will be a little bit complicated because I deleted all the things on my chart.
Oh, darn it. Do you have the links that you posted in the chat? Do you want to share those?
I think so. They're on Discord. I don't know. Yeah. Let me just check a little bit.
Okay, no problem.
I think it's just it's just talking a little bit generally on the trades if it doesn't bother you.
No, it doesn't bother at all.
So, firstly, I have a problem of, like, for example, now when I heard you talking about when you explained the concept firstly, I understood a little bit where I went wrong, where I went wrong. For example, now in this type of market today and yesterday, we can see that the 4 hour time, I mostly trade GBP USD. We can see that now the buys are bullish. But me, I always stayed in my head. I always said to myself that it's still, what can I say? It's still bearish. And for that, every chance I try to take a trade, I try to take sell, not a buy, because I thought that I was on the right idea of thinking that I need to keep with the higher time frame. But when you explained it, it looks like that I was wrong. I need to take for what's happening for the moment, not really general. For when I take a higher time frame, I need to see what's happening for now, not higher time frame, not really the whole higher time frame. Is it that?
I mean, I would consider that in a matter of ways, right? So I pulled up GBP USD. Let me know if
Yeah.
y'all can get the chart.
Yeah.
And let me start before the day started. Hold on one second. All right, here's the day. I think this is like pretty much the day before it started, but this is going back to the Asian session, right? So you have to we combine market structure with the concepts of supply and demand. They go pretty much hand in hand. Price, and this usually what market structure indicator is telling me is that we made a lower high, lower low, lower high, lower low, higher high. Okay, this could have been the sign first that the market was going to buy. But when it came to this last demand zone, the extreme demand zone, what happened? Well, price broke right through that bad boy. So where's my demand? Over there. Okay. Price broke through here. Okay, so what does that mean? Price still will be considered in a downtrend. So I would pull, for instance, this 4 hour supply, and there's now two things that could happen when price goes here. Right now, we know from expectational order flow, price would go from a lower low to a higher high, a lower low, come into the supply if it's really going to stay, and then price would continue down here. Now, we already had the potential, we already had a break right here where price went and did this. So it's still possible that price could come right through here. But at any rate, from a directional bias standpoint, we know price is at least going into here. We just don't know if it's going to stop here or keep going. So now when you go look at your 15 minutes, that means I would be looking for buys. Does that make sense?
Yeah. Me, I always stick with the higher time frame. We are bearish, so I have to take only sells, no buys.
So it's weird because yes, we're in a downtrend, and yes, sales are going to be eventually more high probability, but it's only high probability when we get to a certain point. Until that time, it's going to go into potentially some point and then reverse. And that's when the market structure takes over. That's why the bias in your market structure won't align, but they actually can still be the same thing, because taking buys isn't bad, because I'm not saying that, it's not in a downtrend. It's just going into a supply zone and then might go down. But what ended up happening? Price goes into the zone and goes right through it.
Yeah.
Does that make sense?
Yeah. So now, can we consider that the higher time frame, this is bullish or bearish? Still bearish.
Now at this point, it's broken through, so it would be unconfirmed bullish, because we've had price go through and break this higher high, it came to this lower low. It's going to make a higher high, and so now what from expectational order flow could happen? Price come all the way down here to this last lower low and then go up. And now we have a confirmed uptrend. But price could also, even though at this point we're unconfirmed, price could also come all the way down here and come past this lower low. So you can't rule out both things. You just identified the areas where price could potentially reverse, and then expectational order flow takes over, and then you just wait and react. Does that make sense?
Yeah, pretty much. The second thing, the second thing that I think that went wrong during my trading is trying to identify the correct flip zones, the correct change of character. Because when I am on the 1 minute chart, there is a lot of change of characters. I don't know which one I like to take. And if for example I took like when you explained the concept, when I try to take, for example, the 15-minute zones, a lot of time I either see a quick reaction, just the price hit and then reacted very quickly and then went far away from that zone. So I don't trade, because I always say in my mind that we can see all sort of movements that are out of that zone. So I don't trade. Or I go to 1 minute chart and I try to explain to myself that yes, we tapped into that supply zone, so we're gonna be better. So I'm gonna try always to find a change of character on the 1 minute time frame to re-enter.
You don't always know exactly where those right flip zones will be. You just have to be able to generate what your rules are. So I'm gonna give you an example right here on the 4 hour real quick. Do you see price ended up, this was the last low, this was the last higher high, and it cannot make the lower low, and then it broke through right here, right? So at this point, where would my demand zones I'd be looking for the price to come back into? Here's one right here. Here's one right here. And then it actually engulfs the other one. So these two zones are potentially two zones I could pick. Now, just from my back testing, whenever I have two zones this closely, I go for the lower one. And if price never comes to it, I don't fret, because statistically, I know that if I was to take a trade here, price would probably come and mitigate down here from my back testing. So personally, I'm okay. And then as Nathan's pointing out, look at the liquidity. There's liquidity right there as well too. So we got liquidity that's still intact. As price comes down, it might come down here from a 4 hour perspective, and then price might go out and shut off. So from your back testing, you'll be able to determine what for you is the right, for instance, zone that you can pick, and that it'll help you to refine and pick the right flip zones. But it's not exactly a magic formula. There's what was the most high probability. That's the way you should always think about everything in trading. Is it high probability that price will come in and, for instance, come into this zone? Or if there's two zones right next to each other, 8 times out of 10, it's going to use this as an inducement. It'll come in and tap this zone and then take off. That's what you really know about flip zones.
Yeah. For me, as I said, the problem that I've recognized is that when I am, for example, I'm selecting a 15-minute zone where I see a supply zone. If for example the price tapped right to it and then immediate reaction, good reaction, for example, supply zone, the price went aggressively down. So I will say that now that supply zone is very valid. So what do? I wait on the 1 minute chart for another entry. But the problem is most of the those 3 trades I took yesterday was that 15-minute time frame didn't work. So it did work for the first time. The price action went down, but when it gives me a little bit proof, a little bit of sign that for re-entries, I entered, but the problem is that the price went directly just opposite direction.
Yeah, look, you're just on the wrong side of order flow. I was seeing this in one of the videos before. Like if you have a zone, like you said, you got a supply zone, you got a 1 minute change of character, you love the reaction. It was like a V-shaped reaction in and out. And you took that trade, right? Tapped you in. And then maybe it went into profit for a second, then went straight through stop loss.
Yeah.
That sort of situation. That's just you on the wrong side of order flow. And most likely, when the trend is up, when it's going up on the 15 and you're in bullish order flow, you will get little fake 15-minute chalks, and you will tap into other 15M supply zones, and you will get good reactions. But you have to ask yourself in the moment, what is 15M telling you? You know what I mean? Because think that 1M, it'll chalk at any zone almost. Once it sweeps liquidity, it's bound to get a chalk, and you can't let that go against what you're really truly supposed to see on the 15, which is order flow. Like, what is the chart telling you? The trend is your friend. So don't let them little 1 minute changes a character on 15M supply zones when 15 is within bullish order flow, trick you out to think, you know what, this could go short now. All right.
Yeah. Yeah. Yeah.
Even just wait for extra confirmation on the 15. If it's the thing you do want to take a short trade on the 15, you have, say you have your 15M supply zone. Wait for a second break on the 15 until it creates a second supply zone. At least then, if you have a double break of structure, right, on the 15M, at least then you can say, you know what, I'm willing to take shorts now. But I know exactly what you're saying. And it's just because you're on the wrong side of order flow. That's all.
Yeah, that is for me the thing. Instead of looking for buys, I went for shorts.
Yeah, and you can get some great reactions, like real sharp reactions in and out. And I know how it feels because you're just constantly on the wrong side, you know.
That's the one because for example the trade of yesterday I've seen for example before taking the trade I waited for three break of structure to the downside to take a sell, and when I've seen it was perfect. I found a nice point of entry. I entered to it. The price action went a little bit down and then shoot up.
Yeah. Wait for the 15 to give you a double break of structure on the 15M. Okay, not the 1M. All right.
Okay. Nice. Perfect. I think. Yeah.
Our next question that we have is talking about the difference between back testing and forward testing. So what I'm going to do real quickly is pull up a whiteboard.
You lose a lot of money on one and you don't lose any on the other.
I'll say it again.
You lose a lot of money on one, but not on the other.
Oh, yeah, very true. Very true. So I'm going to answer kind of two questions in one. So the first part of the question was, what's the best way to back test? And the second one was the difference between back testing and forward testing. And like Nathan mentioned, you definitely lose a lot of money on one. So essentially what happens when you back test is when you back test, you go backwards in time. And so it would be, for instance, before I pull up that, let me talk about the difference between back testing and forward testing on the chart. So, all right, cool. So when it comes to back testing, what does that exactly mean? So I'm just going to erase everything from my chart real quick. Oh, there we go. All right, cool. So you come into, like, for instance, this tool, right? Right now, this is where price is currently on GBP USD. You would come all the way back in time. Like, for instance, here, we erase all the candles, and then you would start marking up the chart like you normally do, and then you would play through the candles at whatever speed. Now, the beauty of this is that you get more education in the market, you spend more time in the market. But if you do what's called forward testing would be like you waking up and you would take a demo account and you would take trades on a demo account, or you would take trades on a small account. That's what you consider forward test. And the whole goal, and there are two different goals and objectives that you have in back testing and forward testing. When you do forward testing, your goal is to react to stuff in real time and make sure that you can execute your trading plan in real time and be able to see the results that you generate from a back test. When you have a back test, the real goal of back test is help you to be able to better identify market conditions and the opportunities for entering and exiting the market that align to your trading plan. So when it comes to, for instance, development of your trading strategy and your actual method of trading, you want to start with back testing to be able to help you to gather what we call data to help you to make informed decisions. And so there's a certain way that you go about it. So if I would let this continue to play out, price would continue to play out, and I would annotate the chart, identify supply zones, draw up longs, take profits, etc. And it really helps you to be able to just really be able to do more trading in a short period of time. I found on average that I can take 20 trades per hour on a back test. And that helps me to be able to analyze like results and other kind of things and details. And so let's talk about what does that mean results wise and what things you're looking at. So this is what I usually recommend to people whenever it comes to back tests. So when it comes to back tests, this is how I look at it. Ooh, I wrote horribly. Y'all gonna have to bear with me. My handwriting is worse today than chicken scratch. I think doctors would write better than me. All right. So what I would do is do, for instance, like this. One, I would take 20 trades. And then I'd ask myself a few questions. How many did I win? And slash, how many did I lose? Okay. Then the second question I would ask is, did I follow my trade plan? And that would be a yes or no question. And I would ask that for every single trade, because even if I won or lost, if I didn't follow my trading plan, those wins and losses have no relevance, because the only thing that you can repeat every day in the market, every time you wake up, every day of the week, is your trading plan. You can't repeat a win or a loss, if that makes sense. You don't control if you win or lose trades. You can control when you enter the trades. You control the decision-making process that you make behind trades. You control why you decide, the reasons why you decide to enter. So that's the only thing you should really even be caring about in your back test at first, because that's what really matters the most. Then I start asking myself, okay, what was in common with my wins? Because I want to see, okay, every single time that I had a winning trade, I followed the 4-hour trend, or I had a 4-hour bias, or I waited for a chalk, or I waited for liquidity to be intact when it touched the POI. And you start to gather what are those habits that contribute, that are part of your trading plan, that help you ultimately become a successful trader. Then the fourth question you have to ask yourself is, what was in common with my losses? So now you start to analyze, why did you lose your trades, which is very important. So then you go back and say, oh, I had 20 trades, 15 of them I won, 5 of them I lost. In 3 of my losses, I did not wait for news. In the other 2 of my losses, price just happened to have market conditions that weren't suitable. Okay, great. Now you're collecting some actionable data that you can use and say, well, 75% of the time, my trading strategy is effective according to my back test of what I've done for the last 2 or 3 months. Then you ask yourself a fifth question. Do I need to change anything in my trading plan? And at that point, that's you taking the actionable data that you have and being able to apply it to help you to improve the win rate, the success, the results that you want, higher R's, maybe better quality of trades, helping you to eliminate losses. And then at that point, repeat this. I can't spell today. I would break down and do this process 5x or 10x more times. The goal is that I've taken 100 trades. 100 trades is a large sample size of trades and helps you to really know, for instance, everything that you should hopefully to see. But I try to take a minimum of 200, because then at that point, you get ingrained into it, because the real goal is for you to go through this process and get to the 5th question and say, no, there's nothing in my trading plan I will change. I will continue this path. And if I do that 3 or 4 more times and find that it's consistent, that's where you get the consistency of knowing what to do day in and day out. And I guarantee if you follow in like this kind of method, one, you don't hesitate so much of taking trades. 2, it reduces the FOMO for you that you'll have, because you're not always rushing to get in trades. You're like, I've seen this 300 times before. If it hadn't worked, it didn't work in the majority of the times, I'm not rushing to get in trade. Or 3rd, it really helps you to be able to know exactly when to pull the trigger without hesitation. Because a lot of things that I personally see in the losing trades always boil back to, I can tell how many times you've back tested. I can tell how many times you back tested. I can tell how many times you've collected data on your trades, and I can tell if you have a trading plan or not. It's that apparent in your losses. And over time, you will discover that as well too. I hope that makes sense. Nathan, do you want to add anything to that too?
Yeah, back testing will not teach you patience. So that's what one of the main differences too between back testing and forward testing. Patience is key here as well in this whole trading world. So patience, also discipline, uh, psychology, those are things that will probably come within forward testing, especially if you're using maybe a small live account to start with. Those are the next skills that you'll learn. So just like Brian was saying, you back test, create your plan, understand what's in common with your losses, your wins, what can you change, forward test it then with a little bit of capital if you can, small funds, just to get that psychological feeling, and learn how to be patient and disciplined. Those are the next things to level up on then after that.
Yes, indeed. All right, guys, let me know in the chat if that really helped y'all to understand how back testing should work. Just want to make sure I answer that. And then what is the best time to spend back testing today? I'm gonna add that because kind of a continuation of the question. So there's a couple of different ways that you can really approach when it comes to back testing. You could, for instance, spend an hour every day after the end of the day. You could be able to, just look and see, okay, this is what I've come to, this is what happened during the day today. And you could look at that to be, for instance, an opportunity. You could, for instance, wait on the weekends. One of the best things you could do on a Saturday or even a Sunday is just take some time to back test. Take a couple hours. You have, the market's not in motion. So you could spend, for instance, your weeks, if you want to practice forward testing. You could, if you want to do, for instance, if you want to back test on the weekends while the market's not in session, that's another way that you can approach it. So they're just, a couple of ways that you could really look at it in balancing and doing, back testing and forward testing. I was always tending to do my back testing on weekends. I block out 4 hours a week on Saturdays. I block out another 2 hours on Sundays for me to back test. And that just helped me to hone in to get to the point where even if if I got one eye open, I know how to follow my trading plan. That's the key. So that's something that you can potentially can do as well too. So let me know if that makes sense to you, Eddie.
I'd say as well, Eddie, at the end of the day, do a few end of day markups as well. So if you see any trades that would have fitted your plan, just mark them up, save them, maybe put them in a Notion template so you can journal them too. So something that has saved me quite a lot,
All I know is Brian got the hotline over there.
I do.
He's in Miami.
I'm making money while we speak. That's a good problem to have, right? All right, we're going to take one more question, guys, and then we'll if we didn't get a chance to answer your questions, don't forget, guys, we have our questions part of our Discord, and so we can gladly answer any questions in there, as well as you can also ask questions on either Thursday's Q&A call, on Sunday with Rob. On Sundays, we have our back testing, and we'll have office hours every Tuesday weekly. Or make sure you can always sign up for one-on-one trading with us, and we'll make sure to help you on a one-on-one session for you as well. So you can sign up with either Rob, Nathan, or myself to get like just an hour dedicated time, and you'll find those links within inside Discord. Last question from Eddie. When does a supply and demand become invalid, and when should we look for a new zone? So you should back test this, most importantly, but the thing that I think I use, and I'll let Nathan reply on how he uses, but when a wick goes through a zone, it doesn't exactly invalidate the zone for me, but it means that, for instance, the zone might not be strong enough to be held. So I look at it with less intent. But when I see a body go through a supply and demand zone, at that point, for me, it's invalid. I stop looking at it for any type of entry. What about for you, Nathan?
Yeah, for me, if it wicks it, it's invalid for me unless there's some sort of liquidity that it needed to sweep. So if we say we had a demand zone, we had no inducement, because inducement is quite big for me, right? I need to see a liquidation before I look for an entry. So if I don't have any liquidation, and there is liquidity under my demand zone, and it comes down to sweep it. For me, it's still valid if it's sweeps liquidity below it. If there's no liquidity below it, to me, then it's invalid. Jesus, Brian, the amount of messages.
usually,
What's going on?
usually my computer is on silent, so I'm not even. All right,
So that's
guys.
Nathan.
Brian's Tinder.
I wish.
Miami.
I've never even signed up for the app. I probably, but everybody else does. I probably should. All right, guys. I hope y'all got a lot of value out of this. Again, if you didn't have questions that get answered, make sure to ask them inside the questions chat. And if not, we will catch up with y'all soon. See y'all on Thursday's Q&A call. Thanks so much,
Thanks,
everybody.
guys.